Good afternoon, everyone. We're trying something a little different today. For those of you who don't get up at 7 a.m. on Sunday mornings to listen to the On the Money radio show, we thought we would do a little Facebook Live to kind of highlight the key points from the radio show yesterday. And our radio show yesterday was on Donald Trump, his win in the presidential election, and how that's going to impact your money and your retirement. You know, Donald Trump made a lot of promises during the election campaign. He talked specifically about overturning the Affordable Care Act. He talked about immigration, building a wall, and he also talked about a pretty substantial tax cut for everybody. And his tax plan that he unveiled is probably one of the most dynamic and pro-growth tax plans out there. You're going to find a huge amount of new business investment and companies willing to put their money out there to begin growing the economy. Probably the most distinguishing feature of Donald Trump's tax plan is his hard cap on business taxes at 15%, which is especially appealing to self-employed and freelance people out there. The catch to his tax plan, though, it's going to increase growth, but it's going to reduce revenue enormously, and the federal tax budget will almost inevitably skyrocket. It's going to produce much faster economic growth and a bigger economy as long as you pay zero attention to the fact that it's going to dramatically increase the deficit and the budget debt. So how is that tax plan going to impact you? Well, it's already had an impact. I mean, you know, it's kind of interesting. After the election, most pundits expected the stock market to fall, and the morning after the election, futures were down 800 points on the S&P 500. But we've kind of enjoyed a little bit of a Trump rally here. I guess he's still in the honeymoon phase, and the market has kind of risen. One of the things that we think will happen and has happened, yields on bonds were already rising before the election, but took off afterwards. You know, and this may make you rethink your portfolio. We've often had long-term worries about low yields and limited investment income, and now they've given way to expectations of higher interest rates. In fact, the 10-year Treasury bond, which hit a low earlier this year at about 1.3, was hovering around 1.6 or 1.7. In the course of the past week, it's risen to today. It was at 2.25%. So how does that impact you? A couple different things. It's going to potentially drive people to TIPS, which are Treasury inflation-protected securities. People who want safe money want something, you know, safe and secure like Treasuries. And TIPS, as interest rate rise, will do a good job. Also, financial stocks. Financial stocks tend to benefit from higher interest rates because they make their money on the spread between what they can loan money out at and what they can earn on the money as well in the form of interest. So if they can get higher yields, that's going to affect bank stocks as well. Insurance companies, along with annuities, would also be impacted. Higher yields give the insurance company more money. It's going to increase their yields, their rates. Altogether, higher yields because of a lot of things that Trump's going to do, including his tariffs and so forth. It's probably going to yield to higher inflation and higher yields. We expect interest rates to go up, and you may want to readjust your portfolios accordingly. That's our first version of Facebook Live.